Welcome back to part two of the effect of the current interest rates on multifamily and residential property investments with Eric Stewart and Shad Hammond. In this episode, they speak about pre-approvals, debt service coverage ratio, and more. Enjoy the show.
We were heading down the road of recession, and you guys made some great valid points there with the fact that, we're not quite there yet. Let me ask you this question. Do you guys feel, with everything that's going on in the economy, all the points that you've made thus far, that we may see another 2008?
I'm going to go with a hard no. I'm going to go with a hard no because underwriting in general and lending guidelines are much more responsible than they were in 2008. One of the benchmarks that they've put in place now are the recourse requirements from a lot of these lenders, at least 5 to 10%, meaning there's actually some accountability on these notes that these lenders are underwriting. There's also heavier regulations on banks and heavier stress tests and heavier reserve requirements. So it's a lot more responsible level of underwriting than there was in 2008.
I love it. He's absolutely right. We're dealing with back in 08 and pre-08, we know it was the OK corral, right? We know that there were no doc loans and stated income loans and high frequency. For those who are on a call that are asking, what those are, I mean, literally the name's there, right? Stated income. You'd state what your income was, and that's what the lender took and wrote down, and that's what they underwrote the loan based off of you saying, hey, I make 85 grand a year. Do you? Don't know. I'm not going to check. Looks good on paper. I really want to close this deal and get you in a home. Here you go. So, I mean, it was truly the OK corral where regulation wasn't at a high level, but due to us feeling the pain and the burn, we understand that times have changed and that the federal government and several oversight entities are not going to allow that to happen. But the other thing that to me is, again, fairly obvious to those who much more intelligent than me financially, is the fact that demand is so damn high, right? Demand is extremely high and supply is extremely low. So we know these housing values aren't going to change overnight, right? We know that there isn't going to be, a house that's 375. We have a Georgia person on the call, a young lady that's from Georgia in Marietta for 375. All of a sudden by next year, it's not going to be, at 299. If anything, values have continued to go up exponentially. And now we're seeing maybe some slight cool down, but they're not going to drop. So there really isn't a 2008 in our cards. At least I don't see that anytime soon, not from what we're seeing now.
Well, Shad, I'll say, I really wish it would cool off a lot, like really quickly. My wife and I, we're in the process of trying to find, buy another house. And as you say, the demand itself, now I'm starting to see a little bit of a pullback in days on market of the residential homes, only just slightly in the ones that we're actually looking for. But let me ask you this question. Currently, in your respective areas of expertise, what interest rates are you guys seeing as opposed to 1 year ago?
So right now, it's funny because we know, first off, this is me going to hop on my soapbox. Let me jump on it for at least 20 seconds. In our business, every professional in real estate teaches urgency or preaches urgency, right? You gotta move while the getting's good, while the iron's hot, whatever type of, colloquialism you want to use. You want to jump in while the getting's good. And so sometimes I'll have buyers that I'll pre-approve. I'll pre-approve you in December. And I'm literally talking about a small pocket of folks that I'll pre-approve them in December. They had an eye of the tiger for about 6 weeks. And then they, at some point, will tend to fall off the grid. I'll put them in a drip campaign or text them or speak to them as much as I can. But at some point, they'll lose intensity. I have some of those buyers who pop back on the grid, right? And they cannot imagine that within 6 months, interest rates have doubled what they were, right? And so folks that I had pre-approved in December with high 2s and low 3s or mid 3s, that during the stretch of this year, for at least 3 weeks, we're in the sixes. And again, that's residential lending, 1 to 4 unit, single family home, what we specialize in on our side. But for a time there, we were in the sixes. We hadn't been in the sixes in 15 years. So these rates were much higher than what many of you had grown to be accustomed to. I do remind you that I always say that these rates aren't necessarily high. They're higher than what you're used to.
Yeah.
They're regular, right? This is a regular market, not a high rate interest rate market. But this is what a standard market looks like. Normal playing field looks like. It's just that we've been so low for so long, whether it be artificially or organically, that's what we were used to. But this is where normal real estate commerce typically would operate on.
You kind of closed the door on that one, man. It's exactly right. We've seen low rates for such a long time. If you look at the normal cycles, nothing goes straight up, nothing goes straight down. This is us just starting to normalize after an extended period of low rates, should call them artificially low rates, and then a catastrophic event, right? What happened in March of 2020 really just threw everything out of whack. And now what we're seeing is this oversteering of trying to correct problems and find our straighten out our path again. So to answer the question on the commercial side, yes, just like the resi side, we're well above where we were a year ago, but it's not out of proportion with where we should be. It's a bit of a pain point because it's an adjustment. Anytime you see an adjustment in a market, I mean, you're always going to feel that pain when one aspect of the economy doesn't move in lockstep with another one. You're going to feel the pain. It's like the human body, right? You start running without stretching out, you're going to pull something. Well, that's what happens when these rates move. Everything else doesn't move the same way. It's like you pull a muscle or you hurt yourself. That's what we feel when these rates jump up and prices are still high. Right now, Cedric, you mentioned this earlier, sellers are feeling a lot of pressure to pull down on their pricing a little bit. And we are seeing that. When you talk to brokers that are getting offers, you're probably seeing sellers take a 5% hit, maybe 7% cut right off the bat on the commercial side, just because of the higher cost of funds. So we mentioned earlier, we price our benchmarks off of the 10-year treasury. And right now, a very common rate is between 4.5 and 5. Our rates are going to vary depending on fixed period, how long that rate's fixed, what type of prepayment penalty you're going to have, the size of the loan, that has a lot to do with it. The market will impact your rate as well. Unlike Shad, we don't do the 30-year fixed, right? It's so valuable that he can lock in an interest rate and you can hold that rate for 30 years and you can sell it whenever you want to and you don't have a prepayment penalty. Well, in our world, nobody wants to lock you in there. Nobody wants to give you a 30-year fixed rate. And if you sell it early, there's going to be a prepayment penalty. There's a lot more loopholes to jump through in our commercial space than in the residential space. But if I had to blindfold and throw a dart, it's going to end up in that 4.5 to 5% range of a rate right now.
So with everything going the way that it is, what's happening with the debt markets?
In regards to the commercial side, the liquidity is still very much there. I won't say it's a tightening of credit. We're still working off of our standard guidelines. I think a cap rate decompression or pricing values not running the same clip that they have been is definitely a notable factor for your bridge lenders, your short-term lenders. For your long-term lenders, they're still on board with 80% loan to value, 30-year amortization. The big key now is being able to service that debt, right? In our world, it's the property that has to produce the income to service the debt or make the payment. And just because a program is available that's allowable up to 80% loan to value, in our world, we have to show income from the asset itself that produces usually 25% more than what that mortgage payment is. It's called a debt service coverage ratio. And it's basically the same formula as a DTI, the debt to income ratio, but it's backwards. If we're buying a property and we have a $10,000 a month mortgage payment, we have to show that the property makes $12,500. That's a 1.25 debt service coverage ratio. That is what's capping our leverage right now. We're proceeds driven relative to leverage constrained, which is where we were 2 years ago of let's get all we can get up to 80%, right? Now we're driven by how much of a loan our property can support.
That's how a lot of these loans are structured, right? These investment properties that you are trying to pursue, they're structured in the manner that he had mentioned in terms of, again, are they profitable? Are they generating some type of return on your investment? And Eric also mentioned that right now in this post-COVIDian marketplace, many of us who are in the lending marketplace, there aren't really many restrictions. Everybody's lending at full blast. There are fewer overlays than there were maybe a year or two ago, meaning there are fewer rules that mortgage companies stack their own rules on top of the rules that are normal regulations that we see. So obviously, again, it's not the okay corral, but the price of credit is reasonable and people are still lending at a high proficiency, right? You can get a loan. There's going to be people that want to do business, credit entities that want to do business and want to let you borrow. So once again, move before anything else could change, or we have to deal with any other level of adversity that stops you from getting your very next property.
Have you seen any movement in the debt service rates after the latest 75 basis point increase?
I haven't really seen a ton, and we'll see where we'll go by the end of the year. Some people think because of this last increase that you have some people that just want to hurry up and get it over with. And let's just keep, let's go with 100-point increase next, right? And then you got the other folks who are like, we're on a pretty steady run. And the Fed truly still believes, I think in many ways, that we can come in for a soft landing, although many of us probably don't feel that really even exists, but that we will have some level of soft landing and we'll get used to where things are now, where we're paying more for milk, bread, eggs, and gas. But I don't really see a huge difference with this increase, or maybe even the next, in terms of debt services, or where bond markets are, where the primary versus the secondary market is. I don't really see a lot of change.
I agree with you. I think you're absolutely right. And that said, I think there are some lenders that I have on the bridge space, some short-term lenders that after this last rate hike, they decided to bump their rates up by about 40 basis points or 0.4%. But that was short-term. Again, those are lenders, a couple lenders that they're going to have to exit their deals in 2 years, right? But your long-term loans driven off of that 10-year treasury, they stayed real flat. And I believe it's a function of them pricing it in, because lenders typically, they try to get ahead of these things, and they're in the know, they're studying, they see where things are going. So typically you sell in the news in the stock market, right? Things are priced into the stock market really, really early on. It has the same impact on our interest rates. They get priced in early on, so we don't see that same volatility. Again, I would also ask everybody to consider more of a micro approach. You study your macro markets and big picture these rates, that they're not going to go straight up, they're not going to go straight down. But I go back to my statement before, your fundamentals are still there in your sector of residential housing and real estate in general. That's where you're going to build your wealth. And that's what I would ask you to stay focused on. Whether it's a multifamily property or a single family property, if you can lock your rates in to hedge against them rising in the future, set that debt, ensure that you've got a solid ratio, and own that asset, own that cash flowing asset, and grow your portfolio. I feel like it's the best advice. And I think everybody on this call believes the same thing. That's why we're here.
Tim, I see that you have a question.
Yeah, just one small question. First and foremost, I just want to say thank you for you guys, because you guys are adding a tremendous amount of value. So I just want to say thank you for that. When it comes to metrics, if you can tell me the most important metric that you guys use to, indicating that this is a great deal, there was one thing that you can say that this is a great deal to pick.
It's debt service coverage ratio. It goes back to basic basic Kiyosaki, basic Dalio. If you lock in your debt, you look at your expense ratio, and you're in the black, you're profitable. That's the bottom line. So if there is a metrics, if you have to drill it down to one, debt service coverage ratio. That's basically going to tell you what your margin is above what your expenses are. And that, for me anyway, that's the one that you have to focus on.
I think what the old school adage was that your DSCR doesn't drop below 1.25. And basically, I think it's your net operating income, right? Everything in terms of your full net operating income over your debt service, right? And so once you basically put out a fraction, just like I would do on the resi side with your debt over your income, your operating income, your net operating income over your debt service. And so once you hit the equal sign, that fraction or, percentage, as long as it's over 1.25, it's at least a solid deal. That's just old school, 1.25. Anybody needs help offline in terms of facilitating that fraction or going over all of the operating income factors versus their debt service, we can obviously help you guys with that. But that's just an old school tip that when I came into business, everybody was, what's your DSCR? And I didn't know what the heck that meant. But over time, the business will teach you, and you too will gain more experience. And I remember just that, keeping that in the back of my mind. I even heard Jerome Lewis mention it to somebody else at one of our investment groups, is that DSCR at 1.25.
Okay.
Do that ratio, and it should keep you in some, keep you out of trouble.
For those of you who don't know what DSCR is, it's the cash flow left over after you've paid your debt service, which is your mortgage and your expenses. So that's pretty much what your debt DSCR is. How is the housing supply or lack thereof, Eric, when it comes to multifamily? Is there a glutton or is there a deficit as far as you see it in the multifamily space?
It depends on the market. You've got people clamoring for deals in the real solid MSAs. And actually, your bigger cities, cap rates have compressed and there's not a lot of yield in them. But in your secondary markets, places like Kansas City and Houston, places like that, they're scouring for them, right? So I don't think there's an abundance of deals available on the market. It really comes down to pricing. Are there good deals on the market? There's a lot of deals out there that are priced way too high. So they're very much available. People will sell them to you. But finding that good deal is where it can get tough and it can get really competitive. And so what happens is everybody moves out into the smaller communities because they're doing what's called chasing yield. And now you move into a market where you're taking on more risk because you don't have that population and that tenant base. You don't have those economic drivers that are supporting your tenant base. And those deals are there for you as well. But again, are you ready to take on that higher level of risk? So I don't think there's a lack of deals. There's a lack of deals that are priced right.
That's well said. Very simplistic, but well said. It's lack of deals that are priced right. And you have to ask yourself if the yield that you're going to get now, or have to buy in with the fact that the yield you're going to get now might not be your yield long term, right? But the price of getting in now still trumps the price of getting in well down the line and having that analysis paralysis where you're like, but my investment group, all the guys in my investment group bought 6 months ago, and they're seeing much higher yields and much better return on investment than I'm going to see with this deal. Can't do that. You cannot compare what somebody got 6 to 12 months ago in this market. That FOMO, right? That's the term that people like to use. The best time is, as my mentor says, the best time to buy an investment property is 5 years ago, right? Or it's always, the best time to buy was yesterday, right? And the longer we overanalyze these deals, the more we miss out on opportunity. And so my advice is to still jump into this head first, just like you were going to 6 to 12 months ago, or the reason why you're on this call is because you're ready to do something. That's why you're here. So do it. It may not be the best yield, but what we see is these markets go up and down. You're going to get it when it's down, and you're going to see a better investment, because real estate is a long-term play. This is not a get rich scheme. This is not a, I made, 50 grand 3 months ago from jumping into real estate. Nobody has a story like that, right? So work on that portfolio, build it up. And the longer you have it and the more you build that equity, there's your value right there. But then if you also worry about your month to month yields, you're going to have that. You're going to get in when the market is, you're going to own that property, and the market is going to shift, and you'll be able to either take out equity at where they say the price of credit is cheap. You'll be able to jump in where the price of credit will be much cheaper than it is now, or be able to refi and occupy a lower interest rate. But you can't do any of that if you're not in the game. You got to get in the game, right? And don't worry about what you missed out on in the past, because you'll continue to miss out in the future, if that makes any sense.
Yeah, it's not a get rich quick, it's a get rich for sure game. That's how I look at it.
One of the things Shad's able to do for you is lock in your interest rate. And that's incredibly valuable. I mean, taking that level of risk out of the game, where your rate's locked, you have that baseline for what your debt is. It's a constant now. It's no longer a variable. And he can stabilize your risk basis dramatically, right? With the types of products that he has available in that 1 to 4 space, it's a great place to start. If somebody's apprehensive about getting into the real estate game, with tools like that can mitigate their risk, I don't think it gets any better than that. That's what you do, is talk to Shad, let him structure a fixed rate product for you where you can park it, set it, forget it, make your payment, and just run that cash flow. That's how you get in.
It's
Go ahead,
definitely a pretty safer landscape for those who are new or looking to get into the business because of all those regulations, but because you can lock in with the fixed interest rate for the life of the loan, and a lot of different products that are geared towards either first-time home purchasing or lower level investor. There's products, and if you don't feel you're ready for private lending or hard money or commercial lending, it's a good place to start. I would work with Fannie and Freddie or conventional lending. I do USDA loans for folks that might be slightly off the grid. We'll do veterans loans, VA loans. We do FHA loans where that 3.5% still goes from anywhere between that 1 to the 4 unit. So many of you on the call, I did see a couple eyes go up when folks mentioned house hacking or going with the residential side of lending, where it is a little bit more regulated. There are a lot of people utilizing that same 3.5% down payment FHA, whether again it be that 1 unit up to 4 units. That's one of many house hacks. So that is the form of lending that I do. I do FHA lending. The company that I work for, Loan Depot, is a national lender. We do service all 50 states and territories. I am, like I mentioned, licensed in 39 states, primarily serving the Mid-Atlantic area. Philly, Pennsylvania is where I'm operating out of. Jersey, Delaware, Maryland. I do have my Georgia license that will be activated September 1st. And I'm licensed, like I said, I'm licensed in 39 states. So wherever you're trying to buy, I'm sure I can help you. Somebody on my staff could, and I can oversee the process. And I do a lot of Georgia's down payment assistance programs, if anybody's mentioned any of those to you, and I'm familiar with them.